Buy Bharat Forge, target of 850 rupees, current price 750 rupees. Strong performance by Bharat Forge in fourth quarter of financial year 21 was driven by a strong recovery in the auto export business and resultant benefits of operating leverage. While all core businesses are expected to witness a sharp cyclical recovery, Bharat Forge's huge plans in defense and e-mobility is starting to fructify with the setting up of a greenfield plant focusing on these areas. We raise our consolidated earning per share by 17% to 18% for financial year 22 and 23, driven by revenue upgrades due to a strong cyclical recovery. We maintain our buy rating with a target price of Rs. 850 per share, 28 times March 23 earning per share. Strong performance led by auto and non-auto verticals. Standalone revenue/EBITDA/adjusted profit after tax grew 48% to 125%/LTP year-on-year to 13 billion rupees, 3.3 billion rupees, 2.1 billion rupees. The same in financial year 21 declined 20%/29%/42% year-on-year to 36.5 billion Indian rupees, 7.3 billion Indian rupees, 3.2 billion Indian rupees. Volumes grew 39% year-on-year to 55.8k ton, estimated 55.7k ton. Realizations grew 7% year-on-year, 15% quarter-on-quarter, to 234 Indian rupees. 1k per ton, estimated 214 Indian rupees. 6k per ton, due to better mix and steel price pass-through. Adjusting for the steel price pass-through benefit, realization stood at 227,000 Indian rupees per ton. CV exports/India CV/PV exports grew 66%/126%/48% year-on-year, up 25%/34%/55% quarter-on-quarter. Domestic PVs grew 27% year-on-year, -11% quarter-on-quarter. Non-auto exports grew 22% year-on-year, +91% quarter-on-quarter, due to good performance in both domestic and export markets. Gross margin declined 340 basis point year-on-year to 59.7%, est. 61.8%. However, operating leverage supported EBITDA margin improvement by 870 basis point year-on-year, plus 300 basis point quarter-on-quarter, to 25.5%, est. 24.2%. Forex gains boosted adjusted profit after tax to 2.1 billion Indian rupees, est. 1.6 billion Indian rupees. Highlights from the management interaction. CV Outlook. The outlook for U.S. Class 8 trucks stands at 300k for current year 21 V/S210k and CY20. The management views the $6 trillion US infrastructure push as a big opportunity. The Indian CV industry is expected to pick up from 2H FY22. Greenfield expansion. It is in the process of acquiring 70 hectares of land, with an investment of up to 2.4 billion Indian rupees over 3 years. This facility will provide flexibility to house all new initiatives, including defense and e-mobility. Overseas subsidiaries. Major cost optimization initiatives at overseas subsidiaries have improved EBITDA margin to 10% in 2HCY20 from 5% in FY18 FY19. It expects to drive margin to 12% over the next few quarters in its EU operations. Songvi Forgings. It will help grow the domestic industrial business in wind and hydro energy. BHFC has a robust plan for turnaround of this debt-strapped company. Capex for FY22-FY23 will be INR 2.5B. Highlights from the management interaction. Outlook. The outlook for U.S. Class 8 trucks stands at 300k for CY21, VS210k and CY20. The management views the $6 trillion US infrastructure push as a big opportunity. The Indian CV industry is expected to pick up from 2H FY22. Although CV production in the US and EU was hampered due to chip availability, it expects the shortage to end over the next 2 months. Heavy trucks in North America and EU are seeing a sharp increase in demand. Lightweighting is expected to be a major growth driver. All its recent investments in aluminum technology plants in Nellore, Germany, and the US targets this opportunity. In the medium term, It sees strong growth as its Nellore plant has started operations and third-year capacity has already fully sold out. Greenfield expansion: with current manufacturing locations fully utilized, it is putting up a new greenfield plant near Pune. It is in the process of acquiring 70 hectares of land, with an investment of up to 2.4 billion Indian rupees over 3 years. This facility will provide it flexibility to house all new initiatives, including defense and e-mobility. Defense-related orders have slowed due to the ongoing COVID-related expenses of the government. The current utilization level is till 65% on an average basis. It is expecting operating leverage to help it grow its quarterly revenue to 20 billion Indian rupees at peak capacity utilization. Overseas subsidiaries: major cost optimization initiatives at overseas subsidiaries have improved EBITDA margin to 10% in 2HCY20 from 5% in FY18-FY19. It expects to drive margin to 12% over the next few quarters in its EU operations. It attributes 3 factors for the turnaround in its international business: A. Thrust of lightweight materials, B. Pruning of its product portfolio, and C. Reduction of fixed costs. Songvi Forgings: it has acquired a great asset at a reasonable price. It will help grow the domestic industrial business in wind and hydro energy. BHFC has a robust plan for turnaround of this debt-strapped company. Kalyani Strategic System, defense arm, is now a 100% subsidiary. This change in structure was necessitated to meet eligibility criteria like net worth. ROCE growth plan: it is targeting 20% ROCE and should achieve it by FY22 end, through sales improvement, working capital reduction, and limited capex. Oil and gas revenue in 4Q FY21 stood at 40 US cents to 0.45p/INR 1.36p, peak at 10 billion Indian rupees. It expects to return back to 50% of its peak. Capex for FY22-FY23 will be INR 2.5b. Subscribe for more recommendation.